I guess that's what YouTubers do when they talk about how they screwed up, right? Hi, my name is Matt. Please subscribe to me if you want to follow more of my financial journey. But let's get right into the meat of the matter. So, a large part of my channel is the idea of transparency. I will talk to you guys about every good thing and every mistake that I make financially on this channel. In this channel, I have to talk about a mistake I made starting last year, and I'm paying for it a little bit now. That mistake is buying Nordstrom as a dividend position. So before I talk about, why I dumped them and sold my shares, which is what I did, let's talk about why I like Nordstrom in the first place and what got me into them. So Nordstrom was recommended to me, by a YouTuber online, as you know. I was a new investor back in June 2019. I was looking for ideas. I didn't really understand the idea of thoroughly researching a company and all that fun stuff, but I heard the online persona talk about Nordstrom as a dividend play, and I got pretty excited about that. So I looked into them a little bit. I did read their 10K, their 2018 10K. I was pretty excited that Nordstrom decided to embrace the online persona. So it's no secret that brick and mortar stores are slowly dying out in favor of online sales, and Nordstrom, it feels like it sort of embraced that. So it put effort into both its brick and mortar stores and its online persona. I think I read in the 2018 10K that digital sales accounted for 30% or so of their total sales platform. So it does show that they put a whole lot of effort. Another thing that I liked about them as a dividend play is their payout ratio was very, very low, 46.54%, which is a pretty low payout ratio, which was very attractive. So that's what got me into the stock. The price I felt was relatively cheap. And I mean, over time, the stock price did go up. Now, keep in mind before I go to the next part, that I bought into Nordstrom because I wanted them as a dividend play. I was not buying into them because I expected their stock price to go up or down, whatever. I bought them because I wanted them to pay out dividends. I have other investments that I bought into for growth stuff. So Nordstrom was one of my dividend plays. So I kept buying into Nordstrom, and I kept buying more of their shares throughout the rest of 2019 and well into 2020. And if you're watching the Nordstrom news, especially after their latest report, they did announce that they were cutting their dividends for the next quarter, which it kind of shocked me, but had I been on the ball, I could have seen it coming. Well, looking back through their financials and stuff, there were some red flags that I should have caught. One of the things, and I don't know if I would have caught this since they just released their annual report. I don't know if I would have caught this in time, but their net income was pretty low. It was pretty low. Now, that's to be expected since, all businesses now are being impacted by the whole virus situation. But it's that in tandem with some other things that made me think I should have looked at things a little bit better. Another thing is that I missed is that they have not been increasing their dividends at all for the past 5 years. They haven't increased it. That is not a good sign of a strong dividend-paying company. Not at all. And another thing is that if you look to their cash to debt ratio, that is horrible. That is a really horrible sight. Like, they have really low cash reserves and compared to the long-term debt. Now, debt isn't necessarily a bad thing for a company to have. Not necessarily, especially if they manage their debt well, which you can read about in their 10K about how well they manage it. I didn't read over that part about Nordstrom, but debt, if managed well, is not necessarily a bad thing. The cash to debt ratio, I mean, it is indicative of a company's position to, or the company's ability to weather downturns in the market. So, I mean, it's their ability to hold on, with their cash reserves and their cash equivalents in case bad stuff happens, and they need to use that instead of their profits to pay down debt. Now, Nordstrom had less than stellar profits, and they have a very, very low cash to debt ratio. That right there is a recipe for disaster that I should have saw coming. So, as I mentioned earlier, Nordstrom cut their dividends. Now, they did say that it was a temporary thing and that they are committed to, being a dividend company in the long term. But, I mean, with how their financials look now, if they're going to cut their dividends in this environment, I mean, they're likely to cut them in future economic downturns. So it sort of shakes my faith in them as a long-term dividend investor. Cisco has amazing cash to debt ratio. I am fully confident in their ability to, survive an economic downturn. Now, as far as I know, Cisco has not announced that they were cutting dividends. As a matter of fact, they've been raising their dividends year after year. So I think Cisco is a much more reliable dividend company than Nordstrom. All right, so at that point, I mean, what do I do, right? I mean, the Nordstrom shares are at an all-time low, so I had some choices. I could either wait until the bear market ends, shares are back up, and then I can sell Nordstrom later on, and then reinvest the proceeds into another dividend-paying company. Or I could feel some pain now, cut my losses now, take the loss, and also reinvest in a better dividend-paying company. So I chose option B. I decided that, if I made a mistake, I wanted to hurt a little bit. So, I sold it. And I figured, the company that I picked to put my dividends in, I'm fairly confident that their shares will also rise once the bear market ends. So I will still benefit from some capital gains. And, I mean, I will have a much better dividend company that won't cut their dividends. So where did I learn from this? Other than to better research companies, right? Or at least to better follow the companies that I research and keep up on the news and stuff in case, something happens where I could predict something like this coming, because I feel I should have seen this coming. So after this, I started looking at some more dividend companies because I want another dividend company to fill the void left by Nordstrom. I looked at AT&T, I looked at Verizon. All of them have a pretty pretty poor cash to debt ratios. Now, I haven't researched into whatever the corporate debt crisis is, but a lot of these companies are showing up with lots and lots of debt, and my scared little heart can't take that anymore. So, to keep myself safe, since I am a new investor, I've decided to only invest in dividend companies that have more cash than debt. Bank of America, I checked them out. I know they are a current investment I have. They currently have more debt than cash, so I'll have to reconsider them. Pfizer is another one that has more debt than cash. Now, they are not as bad as Nordstrom, but they have more debt than cash. Now, I mean, I'm not saying I'm going to immediately dump Pfizer, but I am going to give them a second look and see if they're still going to be worth it in the long term. I have found a potential company to invest in. I'm still looking at their 10K and their payout ratio and the balance sheet. One thing I can tell you is that they have a lot of cash and no debt whatsoever. So if it's a company that I decide to pick, I will talk about them in next week's video. So yeah, I mean, that's the mistake I made. So later this week, I'll have a portfolio update, and then the week after, like I said, I'll talk about that new stock pick, assuming I pick them. Have a great one, and eat your vegetables.